With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then Channel Check truly is the orchard. The listed companies support Channel Check, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for Channel Check so you're always up to date on what's going on at the small and microcap data place. Welcome to the Virtual Roadshow series presented by Channel Check. This fireside chat features Chris Young, CFO of Entravision Communications, NYSE ticker symbol EVC. Joining Chris is Michael Kupinski, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed SEC-registered broker-dealer. You can find Noble's research on Entravision on channelcheck.com or by clicking the link in the description. With that, I am pleased to present Chris Young and Michael Kupinski.
For those of you that are new to Entravision, the company is a diversified global media, marketing, and technology company that primarily targets the Hispanic community. It has 49 radio stations, 55 television stations, and a large digital media segment that provides programmatic marketing solutions and performance-based solutions and data insights. And with that, Chris, welcome.
Michael, thanks for having me. Appreciate it. Happy Thursday.
You too. Well, it was a short time ago that the company's main business was driven by your TV business. And the company has gone through just an amazing transformation over the course of the last 24 months through your acquisitions and some very strong growth in your digital businesses, which is now the vast majority of your revenues. And I believe I think in the last quarter was like 73% of your revenues.
That's right.
So I'm going to keep the sizzle of the digital towards the end. So let's focus on your broadcast businesses first.
Sure.
So many of the broadcasters are rebranding. They're making acquisitions outside of their broadcast roots and looking at their media businesses as more mature and just cash cows. How do you view your legacy broadcast businesses? Certainly you've diversified as well, but what are your thoughts on broadcasting and how that might be different from your peers? Do you consider them mature businesses generating significant cash flow but little growth? Are they just cash cows? Or do you believe that there's still favorable growth ahead of them?
Well, I certainly think, and Michael, thanks for having us, by the way, here at Channel Check. I certainly think, and we certainly think that the broadcast industry, TV and radio, is a fairly mature industry as far as media distribution is concerned. But what's less mature and more of an emerging element is the audience that we cater to, which is the U.S. Hispanic here in the United States. And I think that is still a demographic that's very much in growth mode. I think you're seeing it in the politics that play out across the country. I think you're seeing it in the political ad spend that you're seeing with Hispanic broadcasters across the country. And so we see ourselves kind of operating within this more mature industry, but catering to a demographic that's very much got a growth dynamic that's unlike any other here in the U.S. So, it is a strong cash flow generator as far as both our TV and now our radio operations are concerned, and we'll continue to operate those platforms accordingly, catering to the Hispanic demographic, which again is we believe is still in significant growth mode.
So let's talk a little bit more about TV. Ratings continue to be strong for your stations, many markets beating English language stations in terms of ratings. Two of the key growth drivers for the industry has been political and retransmission revenues. And you're a little bit somewhat handicapped on retrans because of your Univision, that they negotiate the rates for in most of your markets and then gives you a cut of that. And I know that you're bound by a master affiliation agreement with them, but would it seem that you would be able to negotiate better terms should you take control over retrans? Since you're bound by the master affiliation agreement, is it beating a dead horse to try to do that, or are you okay with how Univision handles retrans?
It is, because the way our master affiliation agreement was worded way back 25 years ago, Univision has to give us consent to enter into a retransmission agreement with a cable broadcaster, a cable entity. And ultimately, I think Look, Univision has an interest in coming to the cable operators representing the entire Univision family. We can't really, let's say we go and we cut a deal with the cable operator, well, we have to go and then get consent from Univision, and that's just not going to happen. So it's kind of an awkward position that we're in from a negotiation standpoint. It kind of is what it is kind of scenario. Our retransmission deal works with Univision in that Univision negotiates a deal on behalf of all the Univision stations across the country. We get a specific cut of that, and it's in dollar terms. I think next year you're looking at about 27, 28 cents per sub per month that we'll get. The cable companies will pay Univision. Univision will take their cut. In other words, anything on top of that, as far as upside is concerned, they'll keep and they'll remit to us the 27, 28 cents to us, and that's our retransmission consent revenue. Correspondingly, there's no expense that you typically see with English language broadcasters as part of their the network feed, but that's how the retransmission revenue stream works, and that's how it will continue to work.
And that covers the OTT platforms as well, right? I just want to make sure.
It does. So we are on, Univision has cut deals with YouTube TV as well as Fubo TV. So those are just kind of in the early stages of coming online. But yes, that does include those as well.
Gotcha. And what is the, you've always made a mention about the over-the-air viewing on Entravision, that you have very strong ratings predominantly because some in your community do not have cable.
Sure.
Can you talk a little bit about, the value proposition that you have with your TV stations relative to just cable coverage, for instance?
Sure. So the Entravision stations that are piping Univision, those audiences represent approximately 25% of Univision's nightly audience, and we're predominantly in the southwestern part of the United States. And if you look specifically at some of our larger markets, let's take El Paso, for example, the over-the-air viewership in a market like El Paso, which is right on the U.S.-Mexico border, is actually higher than the U.S. average. It's actually around 15%. And the reason for that is there's just not a lot of cable coverage in some of the more remote areas of El Paso. That same phenomena applies in a market like McAllen and Brownsville, where there's just not a lot of cable coverage in more the rural or suburban areas of those markets. So that's where our TV station distribution really becomes important. And if you're talking about, some of the English language networks every now and then begin to talk about going all cable and just discarding the over-the-air broadcasting distribution approach. Well, that really won't work for for a market like ours, where a good portion of the community is still watching over the air.
So one of the other key growth drivers I'm not going to really touch on, I'll let everybody else kind of come up with their own number on political advertising for next year. I think it's anyone's guess as to the amount, but you do get a benefit from the biennial elections in 2022. Has the company given any guidance in terms of what their expectations might be?
So we did about 12 million in change between TV, which was about 10 million, and 2 million for radio in the last midterm elections. I think, because of Orlando and Tampa being important markets for us that are now going over to Univision, so that political opportunity will not be there in 2022. With that said, though, Texas, California, Nevada, they've all got some pretty compelling races that are coming up. So, I would expect our political revenue to be in the neighborhood, even without the Florida markets, of what we did back in the last midterm election of 12 million.
Gotcha. And of course, everybody's been focused on the cyclical bounce or the bounce coming out of the recession and the recovery. And one key element there is your auto advertising. And at one point, in the upcycle, auto was almost 30% of your TV advertising, if I recall.
That's right.
Where does auto sit in terms of the percentage of your revenue now? And are you seeing what are you seeing in terms of categories that are kind of coming back, so to speak?
Sure. Auto now, and we talked about on our earnings conference conference call. Auto was pacing at a -28 for our TV division in the fourth quarter. Auto used to be, to your point, our largest category for TV, representing in excess of 30%. That's now down to kind of, we'll call it the low 20% range. Legal services has certainly picked up some of the slack left by auto. Insurance services, healthcare, quick service restaurants have also picked up. So you've had a number of other categories that have stepped up to kind of fill in the void that's being created by the automotive sector. Now, with that said, we think these automotive, the reduction in automotive spend is really a temporary phenomenon due to the chip issue that we've all talked about ad nauseum this year. And I'm not sure that we should expect to see auto come back to be our number one category, but certainly we do anticipate a renewed strength in that category as we go deeper into next year.
And Chris, a number of other broadcasters have talked a little bit about sports betting and iGaming and so forth. Now that California and Florida looks like they're poised to legalize sports betting, I would assume that this category could become a meaningful category for you. What are your thoughts?
That's interesting you bring that up. So the sports betting phenomena, to your point, is a big voter issue on the docket for next year. That's exciting for us in two ways. It's exciting because there's going to be a lot of money spent on the initiatives here in California, and the bulk of our stations are actually here in California. But it's also exciting because it will open up new opportunities with new vendors in that space that we think is going to be a really interesting long-term proposition. So we're excited on both fronts on that.
Right. And so your relationship with Univision is complicated, and recently they announced that they will be taking over Univision stations from you in Orlando, Tampa, and Washington, D.C. And you mentioned there will be a revenue and cash flow impact, and I believe that number was like 20 million in revenue, 10 million in cash flow, if you can correct me on that.
No, that's exactly right.
Yep. And has the company developed a strategy of yet to mitigate some of the revenue and cash flow impact, and what are some of your options?
So we are currently in negotiation with several content providers for those markets. We're not at a point where we can announce what those arrangements are. So not for me to kind of give you any other answer but a non-answer, but whatever revenue and cash flow that's generated off those deals will help to offset that $20 million revenue loss and $10 million cash flow loss. But we're not there yet as far as being in a position to announce what happens with those stations.
And does all the 20 million roll off? I mean, are there some options that, in terms of retrans, that maybe not all of it rolls off next year?
Yeah, no, not all of it will roll off. Whatever deals that we do, the markets will still have cable coverage. So whatever deals that we do, there will be incremental revenue being generated from those deals to offset that $20 million revenue loss. So it won't be a full 20 million, 10 million revenue cash flow loss. It'll be offset by whatever we announce.
Gotcha. And is there concern that Univision could take over additional affiliation in some of your markets? It seems like Boston, Denver, Albuquerque might be at risk. How significant would that be to you?
Oh, well, you bring those markets up because you've read our 10K. Congratulations. And the reason why Michael brings that up is those are the three other markets where Entravision and Univision both own stations in those markets. And we were there first. Univision ended up doing a deal after our affiliation deal was signed where they ended up with a station in our market. So we had a gentleman's agreement not to compete with each other. So the arrangement was that we will run their station as a Unimos station, and then we will split the cash flow with Univision. So in Orlando, Tampa, and DC, Univision opted to activate their own station in that market and just create an O&O in that market. And Michael's question about those three markets is those are the only other three markets where there is dual ownership of stations between Univision and ourselves. It's early to speculate. We have an affiliation agreement that runs through the end of 2025. We have not yet begun to negotiate what the terms of that new affiliation agreement would look like. It's way too early to speculate. But even draw a worst case scenario where those stations are put in a similar scenario, those economics are not nearly what the economics were for the Florida and DC stations that are about to move over. So,
Gotcha. And I see questions coming in here, and I promise to weave those in, so keep them coming.
Sure.
It sounds like there's also an incredible value for your spectrum in these markets. Going back to the last spectrum auction, which gave you a huge financial boost, you know, that part of your big, huge cash position is because of that. There was talk that your spectrum could be worth north of $2 billion, and probably one of the best companies to benefit from spectrum auctions. What is your sense about future spectrum auctions? Is that a possibility? And do you think that there were some lessons learned from the complicated selling process from the last auction that any future spectrum auctions might be handled differently and actually create even more value for your stations?
Well, it's a great question. We are of the belief that there will be another broadcast auction coming down the pipe. When that actually happens is anyone's guess, but you know, that's one of the reasons why we're not selling any of our TV assets. We believe that there's another auction coming, and if anything, what we learned in the last auction is it's all about who you put to task as far as managing that process. And we had a great team running process on that last auction. And to your point, you know, the broadcast auction was somewhat of a disappointment because there was, you know, a lot of the large potential demand creators didn't actually participate, you know, on the telecom side. And you're seeing subsequent auctions now happen. I'm watching one that's happening as we speak, where the numbers are significantly higher than they were back in the broadcast auction. So that gives us reason to believe that the demand is clearly there. And I think the TV industry is going to be at a point in a couple of years where they're going to be willing participants in yet another auction, and that's a compelling valuation, you know, story for us. Michael, if you recall, you know, one of our largest spectrum valued assets in our portfolio was our Boston station. When we took that out of the auction, it had a value in excess of $300 million just for that station. And that, you know what, that's not lost on us. And you have other compelling valuation stories across our remaining portfolio. Remember, we sold 4 stations back in the broadcast auction for $264 million. And we pulled the Boston station for a strategic reason. It was the right reason, but that's still out there, and it's still a compelling story if and when the FCC comes around, which I think they will. So
I really don't think that the market's focused on the value of your spectrum, and I think I think investors should really kind of consider that as well. Certainly the stock price looks cheap to me, but we'll get to that. So let's chat a little bit about radio. It's been your smallest segment, and largely, you know, in the past it had generated some losses, but there's been amazing turnaround there. You significantly cut cost, and you've had some ratings improvement. Can you give us some color on the turnaround there and what's driving the revenue traction you're getting?
sure, you know, it's been kind of twofold. On the revenue front, we've been executing better, plain and simple. We've brought in some folks, the national team led by Chris Munoz, a former Univision radio executive. We brought him in. He tore down the place and rebuilt it according to his liking. He's got a staff now that is dynamic and ambitious, and they've just been really tearing the place up as far as national revenue generation is concerned. And that's really helped both our network radio and our national spot sales. It's helped us get us through what we hope is the final stages of the pandemic. And then on the other front, there's been the expense cuts that we've been making pretty much over the past couple of years. We started before COVID hit with the cost cuts, and then when COVID hit in full force, we got that much more aggressive. And the bulk of those cuts, you know, that we've taken out of our radio platform are more or less permanent. And over the past 2 years, I think we've taken around $16 to $17 million in core expenses out of the model for radio, and I think that's why you're seeing radio finally, you know, our margins are getting back to kind of a 30 to 40% range, which is the industry norm. And remember, this was a platform that was break even 3 years ago, so it had to be done. We started getting into it in earnest before COVID. COVID just accelerated that process, and now as we emerge from COVID, we're in great shape as far as the radio platform is concerned, and we're excited about how the fourth quarter is shaping up. We're excited about how the year is shaping up, but we're even more excited as we finalize our budget process for next year, because we think there's still a great growth story to talk about as far as the radio platform is concerned.
That's terrific. So let's quickly turn to your digital businesses. You found an interesting niche in the marketing services segment with Cisneros, which was looking for a larger company to accelerate its growth. For some of our viewers that may not be familiar with Cisneros, can you give us a little background and then talk a little bit about the strong growth, the financial muscle that you brought to the company, and what multiple you paid for it in terms of what you thought you had paid for it, and then what turned out to be what you paid for it?
Sure. Cisneros was the first acquisition on the on what we call the digital sales rep front, where Cisneros is in the business predominantly of selling advertising for Facebook in designated areas throughout Latin America. And Ecuador is one of their larger countries, Colombia, Argentina. And basically the way the model works is this: Facebook chooses to outsource their sales process to third-party companies in remote areas of the world, and Cisneros is one of many companies who will provide that service for them. And Cisneros earns a commission anywhere from call it 8 to 25%, depending on, it's not just Facebook, but there are multiple digital platforms that it also sells for. But it earns a commission on the revenue, and it also guarantees the receivables, which is something that Facebook likes because they don't want to be in the business of having to collect. But the one big advantage that if you're a local ad agency in Ecuador that you're provided is that if you buy Facebook advertising through Cisneros, you're afforded a line of credit, which is unlike, even buying here in the US. If you've ever tried to buy advertising on Facebook, you don't get a line of credit. You have to put the money up front in the form of a credit card, and then your credit card gets dinged as the execution of that campaign goes. In Cisneros' case, they're afforded a line of credit, and that line of credit is passed on to our local agency clients, and they get to buy, and then they pay as they go, as far as their line of credit is concerned. One of the interesting things that I think was a game changer for Cisneros is when we showed up, one of their big issues with Facebook was the fact that they had this line of credit that was it was on the smaller side, and they knew if they could get that line of credit expanded, that there was a ton of opportunity in their regions where they're selling Facebook ads that they could take advantage of. And that line of credit, with Entravision's backstopping, we were able to increase from $30 million to well in excess of $100 million now. And that enabled Cisneros to really take off. And so what was at the time of acquisition, a $10 million cash flow company that we acquired 51% of for a valuation of $60 million, so 6 times, ended up being a company today that is trending more along the lines of the low $30 million cash flow generation, tripling its cash flow generation in the span of a year and change. And you can do the math as far as that 6 times is concerned. It's no longer 6 times, it's more akin to 2 times. Now, we consolidated, we bought for 51% back in October of last year. And then we a couple of months ago, we announced that we consolidated the remaining 49%. So now we own 100% of the entity, and that operation continues to operate on all 8 cylinders, and it's been a lot of fun to watch.
It seems like you're replicating the Cisneros acquisition in other parts of the globe, focusing on different countries. Most recently, your acquisition of Media Donuts. So I was just wondering if you could talk a little bit about all of the acquisitions you've made there. And a question that came from our field, are you integrating 365 Digital with Media Donuts?
So that's an interesting question. So let me get back to the acquisitions that were made. So the Media Donuts acquisition that was just asked is basically the same exact business model, but in a different corner of the world. It's based in Singapore, but it provides sales rep services throughout the Southern Asia Pacific Rim. And conversely, instead of Facebook being its core digital client, TikTok is, and then Twitter. And again, it's a situation where global platforms choose to outsource their sales rep services or opportunities, and Media Donuts is there actively selling these digital these digital products. And look, the Cisneros deal was such an acquisition. It was an acquisition that was interesting and fun. We think Media Donuts is equally interesting. It's an earlier stage company. It's not hasn't been around as long as Cisneros had, so there's more dynamic growth prospects, I think, for the Media Donuts platform. That's really exciting. Fast forward again to a couple of months ago, we announced another acquisition called 365. That's the company's name. And 365 is essentially TikTok in Africa, brand new continent, dynamic digital platform that I think everyone is familiar with. That's exciting in and of itself because it's an even earlier stage operation than even Media Donuts. They've only had the TikTok relationship for months, and they're in high growth mode. It's going to be really interesting to see how those folks progress, and we will be integrating part of that. Part of that deal is to be integrating their back office operations with the Entravision conglomerate, like we've been doing with the other entities.
Mostly with Cisneros, then, under that management team.
Mostly with Cisneros. Cisneros was an integral part of that acquisition. They brought the opportunity to us. So yes, that's going to play. Cisneros will play a much more active role in helping us manage that business, correct.
And Chris, as you know, there's always critics, and I probably would say cynics out there regarding your transformation. Some say that, yes, your digital revenues are 73% of your total company, but your businesses recognize the revenues of the entire campaign and not just the commission revenue that you receive. How do you address those cynics, and what would be the revenue composition of the company if you were to recognize revenues based on commission that you receive?
I don't know what there is to be cynical about. Growth is growth, but look, if you're going to go down that path, I mean, look. For the folks who like to value companies based on revenue, which is often done in the digital world, we get that. But it's done for one primary reason, because more often than not, there's no profit to value off of. And so there's no multiple to apply to a negative number that makes sense. So as a fallback, people like to look at revenue and revenue growth and figure out a multiple of revenue for valuation purposes. That's not Entravision. So, we're going to be generating positive EBITDA. Our trailing 12-month EBITDA as of third quarter was north of $80 million. Our free cash flow conversion is approximately 90% of that. So and I think you have our net income at around 42 cents this year. I think that's right. But so there are profitability metrics that you can apply multiples to below the line and come up with valuations. So for the folks who, saying for the cynical folks out there who disagree with the revenue treatment, well, the accounting is what the accounting is. I won't get into that. That's pretty straightforward. But if you're looking for the proper way to value our company, I think the proper way is to, look at the composition of our cash flow generation and apply different multiples, whether that's 6 to 8 times, which is generally the norm between TV and radio these days. And whatever the digital multiple you would like to apply, anywhere from 10 to 15 to 20 times is everything that I've heard. It's a wide range, but that's probably the right way to look about it. And if you wanted to go do the exercise of figuring out what the net margin would be if you're not grossing up the revenue, all you need to do is basically take 9 to 25% commission off of the revenue, remove cost of goods sold, keep the operating expenses in place, and then you have the same cash flow on a significantly reduced revenue. And then if you want to value something off of that on a net basis, you're more than welcome to, but I think you'll come to the same conclusion. So
yeah, and this might be a good point to weave in another question that we have, since you talked a little bit about the valuation. What would you feel, given the digital businesses, what would be the comparable companies do you think EVC should be compared to?
I don't think there is one, to be honest with you, because we're kind of a hybrid. You have pure play digital folks who are only marginally profitable, if profitable at all. And you've got other broadcasters out there that are doing interesting things in the broadcasting space. It's interesting what Town Square has become over the past 5 years with their hyper local digital strategy with existing broadcast clients. I think that's been fantastic and it's been fun to watch. But that's not really the business that we're in. We have a local digital strategy, but we also have a dynamic international digital strategy that's unlike anything out there. So I don't unfortunately have a silver bullet answer to that other than, it depends on what your focus is. There's a company out there that is a primary competitor of ours in the international space. They just changed their name to Aleph, which is the first letter of the Hebrew alphabet. I've heard that they're planning on going public. I don't know anything other than that, but they're out there, and it's a space that is very dynamic and it's interesting. And you know what? If there's a comp out there that I would point to, unfortunately, it's not public yet, but maybe once it becomes public, it will be a great comp to use. But that's all I can really comment on that.
Yeah. So as you look across the globe for businesses like Cisneros, what other countries or regions look attractive and have growth prospects similar to Cisneros or 365 or Media Donuts? And are you looking at more developmental companies like 365 in the space, or companies that are established and have relationships with social media platforms? What is the mode that you would rather make in M&A regarding those?
We're looking at everything. So there are the M&A pipeline is pretty interesting for us right now. There's a ton of stuff we're working on. It's all exciting, and they range between startup-like entities to more mature businesses and in all corners of the planet. So it's tough for me to get specific on any of those, but as the old broadcaster in me likes to say, stay tuned.
So while we are on the subject of M&A, what is your interest in buying terrestrial radio or television?
Well, we'll always take a look at an interesting opportunity as it pertains to our core legacy business. I think, we do have some English language TV stations under our umbrella. We've got the Palm Springs NBC station married with our Univision operations. We've got a handful of Fox stations across the country. We have several English language radio stations across the country. So look, we'll always take a hard look at whatever comes our way, but I think it's safe to say between the legacy broadcast business and the international digital business that the bulk of our time will continue to be spent on the international digital business. And TV and radio, to the extent, like I said, that they're complementary opportunities in market opportunities where we're already, operating. I think that's the kind of the limitation, on terrestrial radio and TV.
And Chris, the company has some sizable NOLs. Can you talk a little bit about when the company expects to become a taxpayer?
Sure. So we've got federal NOLs in excess of $50 million that were generated over time. That a good chunk of those got burned with the FCC proceeds, but we won't be a cash taxpayer for at least several more years. So no need to model that. There will be some international tax associated with our international businesses as that portion of our portfolio grows. But as far as U.S. domestic tax is concerned, again, that'll be near low single-digit kind of millions to near zero for at least the next couple of years.
And you mentioned your strong free cash flow, 90% free cash flow conversion, solid balance sheet. Can you just talk a little bit about the capital allocation priorities for the company? What are the prospects for dividend increase or even share buybacks?
Sure. So we've got, as of third quarter, we had about 183 million of cash. We had 213 million of debt. Our debt deal runs through November of 2024. We're paying 2.84% on our debt because LIBOR is so low. That's a wonderfully low rate. That's enabling us to convert as much as we can and have been as far as free cash flow is concerned. As far as capital allocation is concerned, we did cut our dividend back when COVID hit in full force. The board continues to revisit that dividend policy every single quarter, and it's a robust discussion. And I would expect that trend to continue. And we'll see as far as the next couple of board meetings, where they end up on that front. But again, it's not something that has been forgotten conceptually. It's something that is very proactively discussed. And one of the things you need to factor in as an investor is that we've managed to cobble these acquisitions, the funding of which is coming from either cash or the generation of future free cash flow. And that's important because we haven't had to add a dollar of debt to our balance sheet to facilitate these transactions. And here we are sitting at 180 some odd million of cash. Through free cash flow conversion alone, the balance of our obligations for those acquisitions will be self-funded. And so you can look at that 180 million of cash as our opportunity to continue to use as funding for future acquisitions. So that's exciting to us. That's one of the reasons why we've been very, very diligent and careful with the dividend policy, because we want to make sure what our true cash position is quarter in, quarter out, and not just quarter in, quarter out, but for the next 8 quarters, as we negotiate these deals to pay what is often, the other 50% of the economics, 2 or 3 years down the road. And we think that we've got that tab covered with our free cash flow generation over time, and we want to continue to prudently, acquire entities without having to lever up, and that's the trick in the game. And if you can do that, we know what high leverage does to a company's reputation in the capital markets, and you know what? The dark clouds could come in, in the span of 2 months, as we saw in COVID, and then you have all kinds of uncertainty. And we got a lot of grief. We always get grief for having as much cash as we had. We didn't feel that grief, in February of last year when the world was falling apart, and we didn't take a dime of government money, to get through COVID. And we've just been managing this business in a way that we think is appropriate, to get through tough times, and having that large cash balance is one of those ways of doing so.
And you brought up the pandemic, and obviously, like your peers, everybody went through cost cutting, and what's interesting is that you've maintained a very lean cost structure. And I was wondering if you could just talk a little bit about the cost structure as you go into next year. How do you expect to maintain maybe that cash flow conversion that you talked about as you go into next year?
Yeah, so I mean, we're in budgets right now and having that exact conversation as we speak. And like I've said, in the radio division, we've probably over 2 years taken out $15-16 million of cuts. With TV over the past 2 years, probably around $5 million in cuts. Inflation is here. And inflation's really, we're viewing inflation not from the standpoint of how much a loaf of bread costs, but how much labor costs. And it's becoming trickier and trickier to keep costs down when labor is moving the way it is. So we'll have to kind of move with that as we see fit. But it's going to be tough. I mean, I think everyone in corporate America is faced with this issue, not just us. And we'll do what we can. We think Entravision is, I think we have that tag somewhere, a great place to work. We think the employees like coming to work every day, and we like to think of ourselves as a close-knit family. And you know what? We'll deal with the labor issues as they come. But as far as the EBITDA generation and free cash flow generation, the large components of free cash flow conversion are really your interest expense and your tax bill and your capex. And I don't see capex going anywhere beyond the norm this year. I think we got it around $6.5 million. It's usually around $8 million to $9 million in capex because of the chip issue. However, we had to pull that number back and hold off on some of the things that we wanted to acquire. But again, next year should be more normalized, 8 to 9 million. And then, interest rates could come back in a meaningful way. We'll have to address that as it comes, but I'm not anticipating a huge spike in interest rates over the next 12 to 18 months. I could be wrong about that. But we'll see. And the tax bill, as I've already kind of addressed, because of the NOLs, it'll be a low tax burden. And so that free cash flow conversion should continue to be significant as far as percentage of EBITDA.
And Chris, you mentioned in the last call that that Q4 pacings are very strong. Digital's up 64% and total revenues up 32% year over year. What are some of the key drivers of this growth? And has the fourth quarter continue to be on pace for those types of numbers?
Yeah, you know what? Everything that we see as far as every single platform is concerned is just, it's been a pure pleasure to manage for the balance of the year, and we're even more excited about what we're seeing for fourth quarter. So without getting into specifics, all of the platforms are in growth mode, it's been a lot of fun, and it's going to continue to be a lot of fun, and I think I'll just leave it at that.
Well, Chris, it's been a lot of fun watching the stock price this year. It's had a nice ride from about $1.83 from the start of the year to over $8. But even that rise doesn't really fully reflect the value of your digital businesses. We just talked a little bit about what are the comps, but the stock trades at a discount to some of your broadcast peers. You have a better balance sheet by far than most of your peers. What do you think that investors have not yet understood about this company?
Well, I think first and foremost is getting the word out. We're a micro cap company, growing into a small cap company with aspirations of growing into who knows what kind of cap company we can become. But part of that is getting more smart folks like you to do research on us. That's part of my task. And that is also commensurate with us just getting the word out. And as we continue to grow revenue and grow cash flow, I think the word will get out. And like I said, because we're kind of a hybrid between being a digital organized company and a legacy broadcaster, we don't fit into any one box. And so from a valuation point, to your point earlier, who are the comps for us? It's not a, single company answer. There are multiple answers that you could give. So look, we'll continue to focus on growing our operations. We'll continue to focus on growing cash flow, and hopefully the world will eventually see, and figure out what the appropriate value is. But I don't disagree with you as far as the valuation comment that you had. So we'll focus on continuing to execute and let the world figure it out.
Thank you for joining us for this virtual roadshow presentation brought to you by Channel Check. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelcheck.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and micro-cap companies.